Welcome, D-traders. The World Bank on Tuesday slashed its global growth forecast. Global economic expansion is expected to drop to 2.9% this year from a 4.1% predicted in January. It appears the global geopolitical and economic crisis is still ahead. However, forecast and the actual situation can be very different. For instance, this week the sentiment in the stock market is quite positive. The US stock market has been rising for the second day in a row. On a Tuesday, the benchmark US index closed the trading session with a 1% gain. Currently, the shares of the energy companies and the high-tech sector are pushing stocks higher. In today's Asian session, the stock markets of Australia and Japan were also up amid optimistic sentiment on Wall Street. However, US stock futures fell today. Tensions are growing in the market ahead of inflation data. Moreover, investors are not so worried about soaring inflation or even monetary tightening. They have already priced these two factors in. The main question is how high inflation and rates may affect corporate profits and the economy. Many investors prefer safe haven assets now as they remain pessimistic, awaiting a recession. However, there will also be traders who are willing to buy risk assets despite a real threat of the economic downturn and pessimistic forecasts. The US dollar maintains luster with investors. In the Asian session, the US dollar index climbed after a slight drop on Tuesday. It was again trading in the upward channel of 102.39 and 102.78. Apart from its appeal as a safe haven currency, the greenback advanced following a significant increase in the US Treasury notes. So, 10-year US government bonds were firmly above 3% amid fears that the conflict between Ukraine and Russia would disrupt the global supply chain and push prices even higher. US Treasury Secretary Janet Yellen also said about the unacceptably high levels of inflation. Speaking in the Senate yesterday, they confirmed that inflation will remain high. The US dollar is likely to rise higher thanks to the Fed's hawkish stance and steady economic expansion. During the Asian session, the US dollar index, which measures the strength of the currency against its six main rivals, was trading at 102.72. Whereas the Fed's monetary policy facilitates the growth of the US dollar, the Bank of Japan's policy pushes the yen lower. The Japanese regulator sticks to a dovish approach. Besides, it keeps the yield of long-term bonds near the zero level. So it follows its own path against the general trend of monetary tightening. On a Tuesday, Minister of Economy Shiho Yamagiwa stated that policymakers are closely monitoring how the weak yen affects the economy. In his speech, Bank of Japan Governor Hirohiko Kuroda said that the central bank did not discuss plans to tighten monetary policy. And the dollar-yen pair reached a 20-year high following such statements. The yen is unable to show any resilience due to the widening gap in the key rates between the two banks and rising yields of US bonds. The dollar-yen pair is currently trading at the level of 133.73. The last time the yen traded above 130 was in May of this year. Back then, analysts believed that its sell-off could be stopped by verbal interventions from the central bank or the Ministry of Finance. Now the yen is likely to halt its decline primarily due to risk aversion, but not the Bank of Japan's comments. And this scenario is not correct. By the end of this week, the regulator may switch from verbal intervention to currency intervention. Judging by today's intraday range of 132.57 and 133.86 and a sharp drop of the yen on the chart, this scenario looks quite likely. Unlike the yen, the Aussie maintains its bullish bias. It asserts strength after an aggressive rate hike by the Reserve Bank of Australia. However, it's vulnerable to external factors such as demand in China, which may remain quite restrained. Now, the Reserve Bank of Australia is more hawkish than the Fed. It stimulates the growth of the Australian currency. However, the Fed will soon halt its meeting and the situation may change. To this end, the decrease in the AUD USD pair was hardly surprising. The intraday range of the pair runs between the resistance level of 0.7237 and the support level of 0.7177. At the time of preparing material for this video, the pair had already climbed to 0.7182. After recovering from a deep pandemic crisis, the world economy is forced to confront a new challenge: galloping inflation. Time will show whether the current measures of central banks are effective. And that's all for now. I hope that our up-to-date video reviews help you choose the right strategy and score bigger profits. Feel free to leave your comments down below and see you soon.